Hello and welcome to the second season of Mirai Mutual Fund and Moneycontrol present Decoding the World of ETFs. I am Samira Abdi. So today we are going to capture how passive funds are attracting investors. Passive funds, especially exchange traded funds or ETFs as we know them, are becoming one of the preferred routes of investments by retail investors, especially. And as per a report by the Association of the Mutual Funds of India or AMFI, there has been an increase in the ETF market share now to 9.8% in July 2021 compared to about 7.5% a year ago. And a SEBI report also talks about how the ETF AUM or the assets being managed by ETFs has doubled to 2.9 lakh crores at the end of FY21 compared with just 1.54 lakh crores at the beginning of FY21. So let's talk about how retail investors can look at adding ETFs or passive products to their investment mix. What is the kind of acceptance that we're seeing at the ground level and how you can actually benefit from this whole passive wave. So joining in today, we have Kaustav Belapurkar, Director of Manager Research at Morningstar Investment Advisors, and we have Vaibhav Shah, who's the Head of Marketing and Products at Mirai Asset Investment Managers India. So gentlemen, thank you very much for being a part of this. And ETFs is something that even I am increasingly getting intrigued by, seeing the kind of response it's getting, not just in India, but of course, the world over. So, Kaustav, let me first begin with you because, I can imagine that you've been doing a lot of study on the ETF market. Is it really gaining that kind of acceptance on the ground level from investors?
That's Samara. Hi. And, I think you really hit the nail on the head with your description of, the way the ETF market's been growing, right? In the past, when you thought about ETFs, you would largely think ETF, institutional money coming into, these passive products, but the needle's really moved and significantly, right? There is a lot of chatter and interest from retail investors, high net worth individuals, really coming and investing into the passive space. We think it's only the start. We've seen how this space has evolved globally over the last couple of decades, where while active management's been around for such a long time, but passive funds, especially in markets like the US, has only been growing and getting a bulk of the share of flows. We don't think we're there in India yet, but this is a space that's really nice and clean to watch out for, because it is such an easy product to think about as a retail investor who's looking to enter the market for the first time, doesn't know where to invest, what to buy. So what better than to buy the broader market index? And then obviously there's so many other opportunities within that ETF bucket for he or she to invest.
Okay, Vaibhav, let me ask you, because in India, because there has been this traditional, lure of active funds, right? How are AMCs in India now seeing the growth in passive products compared to the fact that they also have to continue selling active funds?
Yeah, so thanks. I think I echo the sentiments that Kaustav has shared. And we've seen a lot of strides happening globally where, one of the biggest disruptions that has happened in the field of financial sector has been passive investing and ETFs. I think so that trend of disruption has also entered into India, and we've seen that ETF market, which was completely dominated first by gold ETFs and then by a large part of the money invested by EPFOs, has now started to broaden, and a lot more new offerings are also available from the asset management industry. And the retail participation has also grown. In fact, we were just trying to analyze in the last 5 years, we've seen that the retail participation has actually grown 20 times in this 5-year period, which just tells you that this trend is, just started and will grow significantly in size. Now, in the past, there was a lot of debate whether, as an asset management company, whether, you will have active funds or passive funds. But clearly that debate is, rested that as an asset manager, you have to provide a complete basket of solution for investors. So a blend of active and passive, both products should be available for investors to choose from. And I think so this is where the entire, mutual fund industry in India is also moving towards. We've seen a lot of asset management companies having, existing products on the active side, and now looking at strengthening their offering on the passive side as well. So these are initial days, but I think so it's quite promising if we were to see how the next 5 or 10 years unfolds.
Yeah, if one goes just by the kind of conversations that are being started on passive products, one can imagine that there is interest and it's growing progressively. But Costa, what I noticed was that while it's very well that the overall ETF market is growing, and I take that very positively. But the fact is that if you split that basket, you will notice there are so many schemes, and each scheme actually except for the very very popular ones, say which are tracking frontline indices, etc., each has very small market share, right? Some have 0.4%, 1%, 1.5%. Do you think that the ETF market has spread itself too thin in terms of too many offerings and not really consolidating at this early stage or a nascent stage for ETFs in India? I mean, what is the future of ETFs in India?
Yeah. So, that's a very interesting point that you make, right? Because yes, we have seen, a lot of ETF launches that have happened over the past 12, 18 months. But, the important thing is that, there have been portfolios of products that have existed for a fairly long period of time. And interest around that was probably thin, even if I go back, 3, 4 years back. So I think the conversations have really started that, and we'd like to think of it, it's not active versus passive, but active plus passive. And I think investors are increasingly acknowledging that passives can play a very important role in your portfolio. And it can be across any asset class, right? It doesn't have to be always think of ETFs as the context of only equity, but we've seen some great fixed income products come in. Weber rightly mentioned there's gold, there's obviously global ETFs, international equities coming in. So obviously there is a whole bunch of products, but it's going to slowly grow. And I think the proof of the pudding is that the asset managers are acknowledging the fact that this is a space that they all want to be present in, because that's where the investors are going to be looking for. And why not have that product available on the shelf, build a track record, rather than maybe do a knee-jerk sort of thing later down the line when investors are already demanding or looking for it. So I would think it's a pretty good thing. While the assets might be small right now, you are kind of future-proofing your product offering, or from an investor's perspective, there are put that on their radar that okay, these are the offerings beyond the traditional indices. Perhaps I can look at it when I want to make more nuanced investing decisions.
Okay, so fair point then that they're getting the ground ready for perhaps a larger invasion of investors. Webhav, since you spoke about gold, let me take that as an example. Gold ETFs were all the rage, right, at one point in time. Now we see that so many other kinds of ETFs, especially market linked, have taken over. Gold ETF share has been falling. Therefore, what is and this is a reason. This is the product of innovation by AMCs, right? That there are so many newer categories available. How much scope is there for innovation? What can we see in the days ahead?
So honestly, Sumera, what we've seen is on the active side, we've seen that SEBI has clearly laid out which are the categories that an asset management company can offer, and that brings a lot of innovation actually to move to the passive side of the business, where you can actually innovate and create far more indices on different strategies and thought processes. So like we started, the initial days was gold ETF, but you would remember that the gold ETF filed, and actually when it got approved took a very long period of time. As we speak, there is the regulator is working on commodity ETFs, including silver. So that brings you another asset class which investors can look at. We have on the equity side, indices which are mainly on market indices, which is say Nifty, Next 50, the bank index, etc. What we will now see is a lot more work happening on sectors, themes, as well as smart beta, which is where I think so the trend will move towards. So we've seen some launches on momentum, volatility, and few factors. I think so increasingly a large part of innovation will be carrying out combinations of few of these strategies to create strategies based on equity indices. So that's going to be another lever of how asset management companies will approach equity indices. And in the last couple of years, we've seen, debt has just started to look, promising from ETF perspective. We've seen, few funds on GSEC or SGL being launched. I think again, considering that debt is a very larger part of the overall mutual fund industry, debt AUM on the ETF side is significantly low. And I would say most asset management companies are working a lot to try and create a passive offering as well, which will make it attractive for institutional investors. But when you see this as a background in India, we have to see what is happening globally. And globally, the trends are large part of the money is moving towards inverse ETFs or leverage ETFs, etc. And I think so. These are again very important trends that will become you know to India in the maybe few years down the line, but very important that investors are given this option. Now we are seeing that equity markets is hitting all-time highs every day. As an investor, if you're not comfortable with the valuations and you want to take an opposite view on markets, that you feel markets should correct, you should have an investment option and not only futures and options through which you can maybe make your investments and take a opposite view on markets, or in case you feel that the markets can go up significantly from here, you can be allowed to take some leverage bets as well. So these are huge innovations which are happening globally. In fact, inverse as well as leveraged have become quite sizable in size, as well as a lot of thematic ETFs. One thing I wanted to just add, that when you see India as an economy is just 3% of the world's GDP, which means 97% of the world is still outside India. So a lot of innovation is happening on the global side, where we are launching ETFs here, which will give access to global markets, which again opens a huge universe of companies and countries where you can look at investing. So I think so innovation has just started and can see significant growth in the next 5 years.
Wherever you spoke about the innovation that we're seeing globally, what are the lessons that Indian AMCs or Indian investors can learn from the global experience?
Yeah, so Sumera, I think so. What we've seen is that in India we are maybe a late starter, and one of the key things that we can pick up is how to make our product offering based on some of the best practices which are happening on the global markets. I know one of the big trends that we are seeing, and there's a lot of debate on passive products being very low cost, and whether it makes commercial sense for asset management companies to make only ETFs as an offering. When we see the global markets, we see many asset management companies launching differentiated, first of its kind thematic offerings. And now we've seen few themes on artificial intelligence, robotics, fintechs, few ETFs also on things like marijuana and others as well. Now these are very differentiated themes, and when you launch a new index and create an index which tracks such a different theme, for an asset manager also you can be able to charge higher uh, TER on that and make it profitable for you as well as for the distribution community. I know one of the big obstacles that we've seen, Sumera, is that the distribution community has not warmed up to this offering as much as we've seen maybe globally. And we can create based on our learnings of how many companies have countries have launched index funds, fund of funds, and create certain wrapper products through which we can offer ETF offerings for investors. So a lot to learn from global markets, how to use index funds, how to use different thematic funds to make your offering, as well as creating structures like fund of fund and asset allocation structures through which you can combine your overall portfolio. I just wanted to add one more point to what Kaustubh had rightly pointed out is ETF has got one of the key benefits of rebalancing the portfolio. So when you see the way markets are behaving, and in a very short period of time, your asset allocation mix may change. For an investor who wants to quickly do the rebalancing, he can quickly go overweight, underweight on a sector or on a market cap theme and create that right mix for his portfolio. This is also something which a lot of asset management companies are using is to create bundles on asset allocation strategies and offer it under the ETF platform. So some of these, global practices can be looked out to make the choice of Indian investors easier and to make their process of investing much simpler.
Yeah, Vaibhav, I take note of everything you have said, but on this point of expenses, I don't really blame distributors, because some of the most actively managed funds in India are some of the cheapest. I mean, if you look at the direct plan, some of them, flexi cap funds being offered at what, 16 basis points, right? Some of them are cheaper than index funds. So therefore, the difference between direct and regular plan is so massive that how do you consciously tell yourself to market an ETF when you're getting paid so much more for actively managed funds? But anyway, Kaustav, let me come to this whole point of marrying active and passive, and especially at a time we're seeing the introduction of small case investing. How does an investor marry the two in their portfolio?
Yeah, so that's a very interesting thought, and there've been a lot of discussions around how do you do that, right? So, I mean, the simple thing I urge investors to think about is that, like I said, active management is here to stay. It coexists even in markets like the US, where everyone thinking that all the money is moving towards passive. It's just that a smaller proportion of the active managers beat the benchmark. From an Indian context, obviously, the last couple of years have been pretty brutal for active managers, right? But we think it is also the way the structure of the market, and that numbers will probably look a little better, in the years to come. But the truth be told is that active management is becoming a tougher and tougher job, and obviously, active managers need to earn their sort of money by proving that they can consistently keep the benchmark. But I think there are good active managers that exist, and who can do that very well. It's about identifying those consistently run strategies which can add good value and alpha over the benchmark. But if you can't do that as an investor, then go and buy the benchmark ETF, right? Because the biggest problem when we talk about behavioral finance, because we've seen this from a local context, we see that globally, that investors tend to chase performance, especially with active managers, and they're always behind in the cycle. And that could be the worst thing you can do for your portfolio, because you're dumping one good manager for another one. And we spoke about market cycles, we've done these conversations. Yeah. You're probably late, in the journey for that manager or in the market cycle. And by the time his turn comes again, you've dumped him and moved to the next one, right? Because you're chasing performance. ETFs can help you control that behavioral bias. So you can always buy a certain portion, what we call complete core holding in your equity portfolio, just buy the index. Obviously, if you can take that call in terms of identifying the active manager and sticking with them even in the bad times, by all means, add a fair bit of active sort of funds in your portfolio. But there's no harm having a passive buy, which you just like a fill it, shut it, forget it sort of portfolio, buy of your portfolio in that context.
Yeah, Kaustav and I have done a great job of replugging all our old shows. But anyway, just the last word to you. What do you think is required now to increase the penetration of ETFs? I mean, one, of course, is that they have to be incentivized for people to go out there and speak about it. But perhaps that's a topic for the regulator. What do you think, from your perspective as an AMC, would you need to make this into the snowball effect in India?
So Sumera, I would say three key things that are needed for increasing the share of ETFs and increase the growth at which ETFs can grow in India. First is, I think, the financial awareness. That's something that is needed across financial products. But a lot of investors have this confusion of how ETFs work, how you can trade on ETFs, how what are the tracking errors, how should you monitor them. These are simple things that needs to be reinforced to investors, and a lot of webinars, shows, and stuff that you guys do at CNBC, Moneycontrol, and etc. are very, very helpful to inculcate this behavioral change in investors. So first is of course financial literacy. Second is, if you were to see the global trends, one of the key roles played in the growth of ETFs has been the role of liquidity provider, or what we call AP, authorized participant in India. Because you have an ETF offering in India, and we've seen many asset management companies actually falter here. So they may have a good ETF offering, but when you see that the price on the exchange, the bid and the ask spread is significantly high. So when you launch a product, it is left to the market, dynamics of, demand and supply, which are not, perfect in, all market cycles. So the role of the liquidity provider becomes very, very important, because he ensures that the bid ask spread remains near to the actual NAV or the INAV, which is the indicative NAV of the fund. He makes sure that there is enough liquidity for investors to transact, and get a decent entry and exit point. Now that, I think so, is one of the critical things that, asset management companies need to work with authorized participants. And regulatory change in that to incentivize APs is, I would say, equally very, very important, so that large number of people enter to this role of being authorized participants.
Absolutely. Vaibhav, Kaustav, thank you so much for joining in today with all your insights. So there is no doubt that this is a market that has a lot of room and scope to grow, and perhaps it's just getting started at the moment. And three of us perhaps will have ringside view to its growth. Thank you very, very much for joining in, and for
Thank
everybody
you.
who's watching. I hope you enjoyed this offering. If you have any questions and comments, we look forward to hearing from you. Stay safe. Thanks very much.
Thank you.
Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.